Welcome back now to part two of the DFREE Wealth Lab. This is not only part two, but number two. This is the second in our year-long series of our new DFREE Wealth Lab. As you know, a lab is a place where you discover, and after you discover, you do something with or about what you've discovered. What we're discovering are strategies for creating wealth. And every week we're here with experts and outstanding guests, entrepreneurs, thought leaders. And once a month, we have our partners from Prudential who come with licensed professionals, certified financial planners, people who are qualified to help us with our strategies for building wealth. They have at Prudential a campaign called Blueprints for Black Wealth. And the Blueprints team works along with the DFREE team to bring not only to Black America, but to anyone who'll listen, strategies for wealth creation. Our guest last week is our guest this week because the topic is so important. I wanted to break the presentation and conversation into two parts. The topic is your financial house in order? And I know that it's still early in the year and there's still time to get our house in order. There's still time to adjust our mentality and our strategies. So welcome back to part two for this outstanding presentation. The financial planner from Prudential, Rosalyn Glenn, who is also the national treasurer of our largest organizational partner at DFREE, and that's the Delta Sigma Theta Sorority Incorporated. Roz, thank you for staying with me and thank you for this part two presentation.
Thank you for having me, Dr. Soaries. Always a good time to talk with you and to talk about money and to educate folks about ways to build wealth. Always happy to be here and looking forward to the continuation of this conversation.
So last week, Roz, we talked about organizing financial paperwork. We talked about creating a budget and demystifying the whole idea of having a budget. We talked about debt and interest rates and compound interest, and you talked about your personal strategy for saving and the importance of having an emergency fund. This week, we're going to go a little deeper into financial strategies because you've got so many answers to such serious questions that all of us need answers to. So we're going to begin this week by asking you to talk about what it means to do a financial checkup. What areas of our finances should we really zoom in on and have a grasp and concrete understanding about?
So, Dr. Soaries, a little bit about last week, we talked about being organized, and a part of that organization is planning to do financial checkups on a regular basis, particularly financial checkups regarding your health insurance, your life insurance, your long-term care, disability, your property and casualty, really taking a look to make sure that you are properly insured and that your assets are properly insured. We think about insurance in terms of protection because that's what insurance does. It mitigates the risk that comes with living in some instances. So we put, insurance on our cars because if we get in an accident, we want to be able to replace them. We put insurance on our homes because we need to repair them if something happens catastrophically, right? Right? We know the cost of health care is very high and that number goes up as we age. And so really taking a look at all of those things and making sure, number one, that you have the proper coverage for whatever the items you are trying to protect. And in particular, I like to tell people your greatest asset is you, right?
Right.
You are your biggest asset. Your family does not work properly if if you're not a part of it, right? And so, life insurance, we've got to think about the same way we think about car insurance. And we've got to think about life insurance in more ways than just something to bury me with, right?
Right.
Life insurance can help you retire properly. It can help you replace income if you lose your two income household, someone passes away. life insurance can help to replace that income. Disability insurance helps to replace the income. And so, as a part of the financial checkups that we are talking about, is really looking at all of these things, making sure that you've got the proper beneficiaries, right, on all of those documents, and then making sure that you have the proper coverage that you need to mitigate those risks should they happen to you and your family.
Yeah, step 8 in the 12-step DFREE process is called minimize the stress. And that's where we talk about insurance. 55% of our community rent and don't own. And not enough of us know that if you rent an apartment, you need apartment insurance. Listen, folks, I want you to talk to someone like Roz, especially about insurance. If you have no interest or need to talk to a financial professional for anything else, you need to do an insurance audit. You need to do an analysis, and you need to have a professional help you and guide you through that process. So here are 3 things. Number one, there's a QR code in the chat that will connect you directly to Rosalyn Glenn. That's number one. Number two, if you have a question, type your question in the comments right now, and real time we can answer those questions. And then thirdly, you can go to dfree.com/get help. In fact, the link to getting help is in the chat or in the comments or it's somewhere. So just if you see a link to a get help resource, do that, and we can connect you, whether it's needing someone to help you with your debt, needing someone to help you with your insurance analysis. I mean, it's shocking to sit down with a professional and they ask you about all of your insurances and they show you what you're missing. I've been there and I do it on a regular basis because as life changes, our insurance needs change. And that's where professionals come in to really help us. Get the book. If you don't have the book, Say Yes to No Debt. Step 8. Step 8 is minimize the stress, because the stress in my life, I mean, I wrote the book, so it's about my life. The stress in my life went down significantly once I knew that all of my assets and all of my activities and all of my needs were well insured. I mean, I have one policy, it's called an umbrella policy, where if you sue me for anything, that insurance kicks in. It's not just for my house or my car. It's just, it just covers me. I had a person sue me one time because they thought that I would settle and they'd make a lot of money. And my insurance company paid for my lawyer and we settled for nothing. So listen, folks, go to the QR code, because when it comes to insurance, Rosalyn Glenn is going to be able to do for you what so many have done for me, and that is to analyze the insurances that you have. Your car insurance may not be the right insurance. I just talked to someone last week, Roz, who totaled their car. They had an accident, the car was totaled, and the kind of insurance they had didn't even pay off the loan on the car, much less give them enough money to buy a new car. So do an analysis of all of your insurances, including your car insurance, and make sure you're well insured. Oh boy, we could do, listen, we could do a whole series just on insurance, right?
Yeah, yeah.
We don't have time for that. What's next? Let's talk about health insurance. The politicians have just completely confused the issue of health insurance. And so, if you don't mind, take a little time to talk about health insurance and at least the key things we need to know about it.
Yeah, so usually during our annual or open enrollment time, right, with our companies, if you're employed, we go through open enrollment, and most people don't really stop and take the time to look at the types of insurance that are available to you, because it's going to be dependent upon what you need for yourself and your family. Understanding what the out-of-pocket limits are, understanding the type of care that you can get, and the amount of money that you are still going to be responsible for when you're looking at your health insurance. So those things are real important, so that you can even know, as relates to health insurance, are your medical care providers even accepting the type of insurance that you currently have, because this can be and is one of the most expensive things that people, because we don't think about healthcare until we have to think about healthcare. So really taking a look, understanding what your premiums are, understanding what your co-payments are, making sure that you are staying within network. Because if you go to a provider outside of the network, then you could be responsible for 100% of the payment of that care. And so really taking a look at the features and benefits of your health insurance is critical to your wealth management and making sure that you're not impacting your ability, because if you've got to pay for healthcare costs out of pocket, it can derail a budget very quickly.
Right. And you know, the number one cause for bankruptcies today in this country is medical bills.
Mhm.
When medical bills mount and there's no insurance to cover it, people file bankruptcy. It's the number one cause for bankruptcy. And therefore, knowing about health insurance, especially if you don't have a job and don't have employer-sponsored health insurance, is absolutely critical. So, I have twin sons. I have twin sons, and I always brag about the fact that my insurance was so good that I never even saw the bill. But I learned that the bill was $40,000, and that was 36 years ago. So I can't emphasize this health insurance enough. Long-term care insurance is something that we almost always overlook. I don't know what the data says, but very few people that I know have long-term care insurance. What is long-term care insurance?
Yeah. So first of all, long-term care insurance is insurance that helps you if you become terminally or chronically ill, and you have to pay for long-term care. And paying for long-term care out of pocket is very expensive. On average, if you are having to go into some type of, assisted living facility, because you need long-term care, that can easily be, in the really good ones, anywhere from $6,000 to $8,000. Here in South Carolina, where I live, it can be upwards of $10,000 a month,
Mhm.
that you are having to pay for long-term care insurance. And so you want to make sure that you have something in place to mitigate that. Now, in the Black community, it is typical that we're gonna take care of Big Mama now. We just gonna, we're gonna do it, right? And back in the day, that used to work, but today, that is not working, right? And so it's impacting, especially if you're in what we call the sandwich generation, where you have children on one side, you got parents on the other side. Putting long-term care in place now, for yourself, so that your children kind of don't end up being that care for you. I used to cringe sometimes. I lost my mom around this time last year. But one of her things that she used to enjoy saying is that her children were her retirement plan. Now, I used
Right.
to remind her, Mom, that is not a good plan. But we took care of her and made sure. But long-term care insurance involves the help and supervision provided to someone with some kind of, severe cognitive impairment, or a chronic illness, or some type of disability, and you want to put those things in place now. There are insurances that can help to mitigate that risk should it become something you have to contend with as you age. And so definitely having a conversation about long-term care. And you can do that through a standalone long-term care policy, or a life insurance policy that has a rider that also provides that type of care. But having the conversation about what your needs are can be beneficial for you down the road.
Right. I think the most consistent complaint we get at DFREE about long-term care insurance is that it's so expensive. Talk about the the best way to not have long-term care insurance that is super expensive.
So the difference in, as I mentioned, the standalone long-term care policies, right? Because you can buy a standalone long-term care policy and it will cover, you want to look at the features and benefits and make sure it meets the needs that you have for yourself. And those can get expensive. They also can work like car insurance, right? You pay that premium, If you never need to use it, then you feel like it's just money you've wasted, which is why the insurance industry, I think, got a little bit wiser, and they started adding riders to life insurance policies that afford you the opportunity to accelerate the death benefit on a life insurance policy to provide long-term care like needs. So again, looking at those differences, it can help with the cost of it, because in the instance of doing a rider on a life insurance policy, somebody is going to get the benefit of that premium one way or the other. Either you
Hmm.
while you're living, because you're able to accelerate the death benefit, or your beneficiaries once you are deceased, because they are getting that death benefit, or they're the beneficiary of the death benefit on that life insurance policy. That helps to lessen the costs that come with long-term care insurance, those standalone policies. But
Yeah.
again, that's a conversation to have, because depending on what your certain situation may be, it may be best, one or the other may be better for you. And having that conversation will help us to determine that.
So, Rob, is it also true that the younger you are when you buy the insurance, the less it costs?
Absolutely. So with my clients, I tell them, as it relates to insurance, period, long-term care or life insurance, the younger you are, the better health you are in, the less expensive that cost, that premium is going to be. And so putting these things in place, you can put life insurance on children, and I recommend that you do. Pay it like a term policy for 20, 30 years, and then that policy covers them the whole of their life. And so yes, it's going to make a difference in the cost, and long-term care insurance can be costly. And there are very few carriers anymore in that space, which is what makes it so costly, because they're kind of
Hmm.
monopolizing that space, right? But
Right.
you want to put it in place while you're young and in good health. Life insurance, particularly long-term care, we generally don't even start looking at long-term care until you're around in your 40s, and we start putting or having that conversation. But with life insurance, you can have it as early as 20, and mitigate that risk because you anticipate you may have it.
Right. This is very relevant for me. My mom is 94, and
Wow.
her long-term care strategy is her children, just like your mom. And so I'm my sons are grown, thank God, but my mom is 94, and my sister and my brother and I are responsible for her. And folks, we're living longer now. You know, we're living longer than any previous generation, and
Mhm.
the healthcare system tries to keep us alive. So this is, again, this is something we're talking about. Is your financial house in order? This is directly related to your financial house, because whatever wealth you do accumulate, 5, 6 years of illness after you're 80, 85 years old can wipe out everything that you've saved and
Mhm.
invested to achieve. All right.
Yes.
I gave a speech when DFREE first started at an insurance company in Massachusetts. And after my speech, I learned something I had never known, and that was that I was more likely to become disabled before I was 65 than I would die before 65. And that was
Mhm.
shocking. And I went back and changed the D3 workbook. And now in the new book, I have a whole section on disability, because most people don't prepare for disability, knowing that the odds are that they might be disabled before 65 in greater proportion than they're likely to die. So
Mhm.
what is disability insurance, and how do you teach your clients about treating disability insurance?
So, disability insurance provides a steady stream of income if you lose your ability to earn a living, due to some kind of qualifying disability. And that's why that statistic is so high, right? That's more likely to happen than you dying prematurely. And so there are certain forms of it, short-term disability, which generally goes in place anywhere from 30 to 60 days if you're going to be out for a short period of time. Or there's long-term disability, where you may be out for a longer period of time. And so you want to make sure that you are covering that. It replaces the income. And there are policies that can replace, anywhere from 50% of your income up to 100% of your income. And you'll want to, make sure that the policies are in place. Most times your companies will offer that, but you can also have a standalone disability insurance. And for business owners, I strongly encourage, because if you're needed in order to produce the income and you're not able to produce it, then you want to have some disability insurance coverage in place to be able to still get some level of income coming into your home, if you are unable to do the duties that you have in place. In general, when looking at disability insurance, you want to make sure that you look at what the definition of the disability is. You want to look at the waiting period, how long you have to wait before you can receive the benefit. You want to look at the length of coverage. How long is the coverage going to be for? Some disability policies have an inflation adjustment, so you want to be able to adjust with the times. And then you want to make sure that some of those policies, do they guarantee present and future costs, right? Depending on when you go on a disability, if you're on it for a long period of time, you want to make sure that the income can support that. And so, disability income just simply replaces your income when you are no longer able to work for yourself. And you'll want to make sure you have that in place to kind of help mitigate some of the risks that come along with becoming disabled.
And folks, this takes us all the way back to the beginning last week, because having a budget, having some savings, having minimal to no debt helps you manage with the disability income. Very few disability plans replace 100% of your income, which means that you're going to want to be able to live off of the income that you do make from your disability benefit. And it will necessarily require that you have your priorities, that you know your expenses, that you do all of what we said last week. If you missed last week, go back and watch it, because last week was really a prerequisite for this week. Because if you don't do what we talked about last week, you're probably not likely to do what we're talking about this week. So I'd like to thank Roz. Roz, thank you so much. You break this down in such an accessible way, and anyone I think can understand it. Don't forget, folks, Roz's QR code to reach her directly is in the chat. And then there's a link for our Get Help platform in the chat. And then in the comments, you can ask questions right now. There are professionals available to answer your questions, and there's staff available at DFREE to refer your questions to other kinds of professionals. Don't wait until tomorrow. Take action now. You've got 11 months left in this year, and that's certainly sufficient time to change your financial future, no matter what age you are or what your condition is today. All right, now we'll come to the insurances that most people are familiar with: the house and the car. Not so much the umbrella. I talked about my umbrella policy. You may want to explain it better than I did, but let's talk about property and casualty insurances and include those things that people really need to know about property insurance.
Absolutely. So, property and casualty insurance is what we know as our home insurance, our auto insurance, and to your point earlier, the umbrella coverage. Home insurance is just that, right? It provides, if something happens to your home, someone comes on your property and they get hurt, you want to make sure that you have the proper homeowners insurance in place, and that you have the proper replacement costs. You mentioned earlier about the person with the auto coverage that didn't have enough coverage to make sure that they could replace their auto, right? So you want to look at those coverages. It helps to pay for the damage to your auto. And if you get in an accident, and if it's your fault, if you've got to even pay for the damages to other people's property, right? So you want to make sure you have those things in place. And to your point, the umbrella policy is really that. It's just a general policy that provides additional liability coverage in excess of the liability coverage provided by the other insurances, like your homeowners, your renters. As an entrepreneur, as a business owner, Dr. Soaries, you definitely have to have, I definitely have to have an umbrella policy that's kind of like a catch-all.
Right.
Everything else that we don't have insurance for, the
Right.
umbrella coverage catches those things and protects us from any liabilities that we may incur as a result of those things. And so for most people, homeowners and auto, you're going to be fine. For others who are doing extra thing, particularly if you pick up a little side hustle that we talked about last week, if you're doing some, generating some extra income, by one of your hobbies or that sort of thing, you put yourself at risk. And so
Yeah.
you want to put an umbrella policy in place to protect you against those risks.
Yeah. I mean, if you sell a sweet potato pie and somebody thinks they got sick from your pie, they will sue you.
Yep.
And there's a lawyer who will offer to sue you on their behalf, and you need insurance. That's what your umbrella policy does. And then in certain types of businesses and technology, you have errors and omissions in
Mm-hmm.
policies so that if you have a client and you make a mistake and it costs that client either financially, reputationally, you have insurance to cover you there. Just be well insured. Insurance is just one of the overlooked risk mitigants that we sometimes experience. And I can't say enough about insurance. My dad actually had insurance, and so when he died at 47, my mother was 44, and the mortgage on the house was paid off. All of his bills were paid off. And had he not had that kind of insurance, I don't know what would have happened to my mother at 44 years old, who had not worked since they got married. So,
Wow.
all right, let's go on now. If you have questions about insurance specifically, go in the chat. Contact Roz. Don't have a question about insurance because it's too urgent. You could have an accident today. You could die tomorrow. You could become disabled this weekend. So don't put off your conversations about insurance. I would rather you get an expert to talk about insurance before talking about saving, investing, real estate, because insurance may be something you need tomorrow, tonight. So use the QR code, get to Roz, and ask her questions about insurance. She'll talk to you and help you understand what your needs are, and then help you put together a strategy to fill the gaps, whatever the gaps are, and show you how to execute that strategy. All right, that's insurance. Now let's talk about retirement. I am technically and legally retired. You know that. I've worked on my job 31 years. However, I have not touched any of my retirement money because I'm still working and generating income. But there are retirement issues that start with planning. And so let's start talking about planning for retirement, and then we'll talk about medical costs and investing for retirement.
Absolutely. So I like to tell people that really, especially my young folks, right? You've got to start planning for retirement as soon as you get your first job, right? You need to have an idea. You need to think about, your budget and what your needs are now, and your budget and what your needs may be when you are in retirement. What kind of lifestyle do you want to live in retirement? Do you want to maintain that same standard of living? And if so, you've got to be planning now for that to happen. So when we start looking at that, and even, when do you want to retire? My personal retirement goal is 60. Now, I'm going to be ready to retire at 60. Will I retire at 60? Probably going to do much like you, Dr. Soaries. I may quit doing one thing, but I love so much what I'm doing here that I'm likely going to be doing this until the Lord says I can't, right? And so
30
you
years.
want to think about those things, right?
You got 30 years.
And you can't, I'm sorry.
You got 30 years before you turn 60, so you got time.
Thank you. You're so kind. You're so kind. But you want to understand even how your Social Security benefits are going to be used at that time in retirement. Now, in our community, because we can take Social Security at 62, most of us say, when I get 62, I am going to take it. I am going to caution you to think about that because you take it at 62. I have clients right now who like to brag about the fact that they have now been in retirement longer than they worked, right? I have a 94 and a 92-year-old client that love to brag about that. And so you want to be strategic about when you take your Social Security benefits, because when you take it at 62, you get an automatic deduction. And so when
Right.
you're talking about retiring and understanding inflation, understanding the income tax rates, understanding, your health. Are you in good health now? Are you doing things now to maintain that good health into retirement? All I'm saying at the end of the day is you have to plan to retire. You cannot just wake up tomorrow morning and decide, just because I've got the years in, I've got the time in, these people are getting on my nerves, I am done. You can't do that. You've got to be strategic and intentional about planning your retirement. And you can do that. And I encourage you to do that, so that you are in control. You want to be in control always.
Yeah, I agree. I don't give financial advice, but to family and friends who are approaching their 60s, I beg them to really consider and plan to wait as long as they can to start collecting Social Security. The longer
Mhm.
you wait, the more you will collect. And, I think Social Security is going to be here in some form for a long time. I think the younger people today may have to wait a little longer to collect Social Security, but I don't think there's a politician in Washington now or ever who will just stop Social Security. Social Security is here to stay, but you may have to wait beyond 62 and 66 to start collecting. But yeah, the planning is the key, and the planning is directly related, as Ross said, to what your lifestyle intends to be. And very few of us need to live the same way at 80 that we lived at 50, but we may choose to do so, and you have to be ready for that. So
Mhm.
how do you professionals do the math around needs? How do inflation's a factor, lifestyle's a factor. What kind of math do you do with your clients in planning for retirement?
Well, it goes back to the individual, right? It goes back to looking at the individual, understanding what their needs and their goals are, understanding what assets that they have to deal with it. And frankly, it goes back to the conversation last week. What do you need in your budget in order to be able to accomplish? And all of us don't need the same thing. So the formula is going to be different from family to family. If you are, a family of five, and your needs gonna be way different than mine. I'm single and no kids, and so it just varies, and we kind of take a look at what your monthly expenses are, and then we make projections from there. Now, I'd like to take credit and say we do that in our head, but I won't. We have technology that helps us to plug in that information and do the projections for us based on what you tell us you want to accomplish. And that's why it varies from person to person. But these are the things that we look at: your basic needs, food, shelter, transportation. I like to say to my clients, we'll create a paycheck because there are some things we know you're absolutely going to need, but then we'll also create a play check, because in retirement, if you like to play golf when you're working, you may only be able to do it on the weekend. But when you retire, you can do it 5 days a week. And so your expenses may increase for golfing, whereas when you were working, you didn't have the time. So that's where it gets back to the lifestyle conversation and having that conversation about what it is that you want to accomplish. What assets have you already accumulated? I have to have conversations sometimes with my clients that come and say, okay, I'm ready to retire in 6 months. And I have to give them the sad news that you haven't prepared to retire in 6 months. And then we do the projections, and I might say, you've got to work another year, 2, 3 even, before you can retire if you want to maintain your same standard of living. And so we're able to look at all of that and have a real honest conversation with you to make the projections about your retirement timing, your lifestyle in retirement, what the needs are. We're not going to be able to project, what tax liabilities you may be, because that's subject to change. But we look at all of those factors to help you determine what that looks like.
Yeah, Roz, this model assumes a 3.5% annual inflation rate, which many people don't even think about inflation. But how reliable has that been over time, that 3.5%?
We use that number because it has been reliable.
Hmm.
Just when we look back historically, the way inflation has performed historically, that 3% has been pretty consistent. A dollar today is not going to buy the same things that, in years to come. And
Right,
so, historically, that 3.5% has been what we have used to make these projections.
right. The day Martin Luther King was killed, 1968, gasoline was 34 cents a gallon.
Mhm.
So uh, inflation is real and
It is
impacts
a
us
real thing.
within our lifetime. Yeah. And we have
Yes.
to factor it in. And
Sure.
then medical costs, Lord knows, medical costs have increased and continue to increase. Not sure they'll ever go down, but what's your perspective on medical costs?
You said it earlier, Dr. Soaries. Medical expenses are the thing that really can derail a retirement. There are projections, as you see here, that a 65-year-old couple will need upwards of $330,000 over that span of time to pay for medical expenses for the remainder of their lives. And so, and that's just an average. It could be more depending on how long you live and the region of the country you're in. It could be more. Nearly half of Americans, I think, aged 50 to 64, worry that they won't be able to afford health care when they retire. And this number includes not only, medical expenses, but Medicare is not free, right? There is a cost to Medicare. And so this includes those premiums that you're going to have to pay for Medicare as well. And so, you really, we can't control the medical costs. We can't control big pharma and what it's costing, to even get your subscriptions at this time. And so it has a way of derailing retirement, and we have to consider that. Even if you're in really good health right now, we still have that conversation and we consider what that will look like for you in retirement based on your family history, as you share that with us, and we make those assessments from there.
$330,000 for medical expenses for the rest of your life after you turn 65, which means you're making less but spending more on healthcare. That's
Yeah.
a daunting reality and intimidating challenge, to say the least, for those of us over 65.
Planning is the key, right? Planning
Well,
for that, or trying to mitigate that risk, because we can never, totally um, manage that, but we can put things in place now to mitigate that, anticipating that that is going to be the case, because historically that's kind of what has happened. As we age, we have increased medical expenses. And
Yeah.
we visit the doctors more often.
You talked about what did you say? Pay money, play money,
The
and
paycheck and the play check.
paycheck and play check. We need to add a pray check.
You're right.
Pray. The older we get, the more we need to pray. My Lord,
Absolutely.
$300.
Absolutely.
All right, let's change subjects. It's getting depressing now. You were motivating last week. You're depressing this week. Uh,
I'm not gonna leave you in that state though. I'm gonna leave you with saying what planning for this, having a plan. You've said it. You say it in your book often. Being intentional, having a plan, putting things in place, giving your money an assignment will help you not to face these daunting stats that we share. And we share them not to make you fearful, but to share with you what the experience has been, because these are real numbers based off of real experiences, and we're urging you to be thoughtful and mindful about that, to put things in place now so it doesn't impact you later in life.
yeah, I mean, in one of my training modules for DFREE facilitators, what I say is that we should probably call some of this pay attention. Pay attention to reality. We are so distracted by social media, by Netflix, by all kinds of distractions that we've got to pay attention to our finances. If we pay attention, we will discover, this is the Wealth Lab, where we discover solutions and strategies. And after we discover them, we can execute and get busy. Listen, we may not end up being billionaires, but we can end up being self-sufficient. We can end up being stress-free. We can end up being in a position that we would not have been had we not really paid attention. That's why I love people like you, because you are as committed to education, which basically doesn't pay anything. I mean, you don't get paid to do this. You get paid to do what you do. But when you do this because not of your job, but because of your passion and your commitment to help people. Um,
Absolutely.
when we talk about investing, we have to distinguish between trading and investing, because more and more we get bombarded by advertisements and by offers, to put $1,000 into something that will double in 3 weeks. And folks, that's not investing, that's trading. And we're going to talk about investing because investing is long term. Trading is quick fix and short term. So we're not talking about trading. We're talking about investing. And so would you give us some sense of what kind of perspective we need to have if we're to become investors?
Absolutely. We talked about last week during our conversation saying that um, you're not going to be able to work enough to build wealth. You're going to have to invest. And the key to investing is to do it as early as you can, do it as consistently as you can, for as long as you can. It is important to keep investing through all of the market cycles, because the market is going to do what it's always done. It goes up and down, and it's been doing that since its inception. And so you don't want to necessarily get caught up in trying to timing the market, as we like to say. You want to be more invested in the time in the market. And the longer you are in the market, the more apt you are to outpace it, because you're in it over a longer period of time. Everyone, we do the opposite, right? We buy low and we sell high. But most investors, kind of get caught up in the heat of the moment. And when the market starts going down, we want to get out, and then we lock in those losses.
Right.
Or because we hear, something is doing so well, we get in, and so we buy it at its highest, at its peak. And so we've really got to understand, and this slide kind of shows us that we don't want to be emotional around investing. We want to be consistent. And we want to be optimistic, because in the history of the market, it's never been down more than it's been up. Now it has been down across, certain periods. Most of us remember 2008 very vividly. But in its history, it's never been down more than it's been up. And so the key to investing is to maintain that long term perspective and to do it consistently over time. And just like you see with your 401ks, when you do that consistently and you don't borrow and take the money out of it, or when you leave a job, you don't, roll it out and spend it, but you roll it over into an IRA and keep adding to it, over time, you take that active role, and then you're able to build, and you're able to invest, and you're able to see the efforts of your labor. So to your point, we are talking about investing. I tell my clients, I don't know what the market is going to do, but I can hear what your goals and objectives are, and we can make investments based on what you tell me your goals and objectives are. And for your short-term goals, we're going to invest in something more conservative. For your long-term goals, we may be, very aggressive, because we've got time to ride the market out and let the market do what it does. And we're rebalancing your portfolio on a regular basis, and we're managing it to grow so that you can meet your needs.
Yeah. Now I know this is subjective, but just give a point of view on what I should be thinking when I hear the term short term, because again, these traders are marketing short term as 1 week, 2 weeks, 4 weeks. And my sense is that short term as an investor should be considered longer than that. So talk about, if I come to you and say, look, I've got $100,000 or I've got $100 and I want to invest, how much time do you need to help me in a respectable way and in a realistic way? How soon should I be thinking about seeing some return on my investment?
So, and I am answering this kind of on a high level. It
Right.
really
Right.
depends on when you bring me that $100 or $100,000. I'm going to ask you, well, what are we doing with this? Right?
Right.
What is this for? Are you going to be buying a house in the next 6 months? Um, or is this long term money that you just want to grow? And when you tell me what the purposes of the funds are, then I'm going to make that determination. Because if you say, well, I'm going to need this money in 6 months, then I'm going to tell you, well, I can likely put it here. This, wherever we put it, this portfolio has managed a, rate of return of, in short term, usually 3 or 4%, because I'm going to be putting it somewhere conservative. But this is what we can likely look to you getting in that short term. When I'm talking in general about long term, I am generally talking about in terms of years, as we're talking about investing, because investing is long term. So over years, 1 to 3 years is considered short term, 4 to 6 years is considered midterm, 7+ years is considered long term. So we're generally talking about in years, but when it comes down to a specific pot of money, I'll give you this example. I had a client, unfortunately, her parents passed away, her mother passed away, but she was in the middle of buying a home. And so she was
Mhm.
going to use some of the death proceeds to be able to buy a home that she was going to be closing on in the next 3 months. And so we put that in a short-term portfolio that got her, a pretty decent amount of return for that short period without her losing any of the principal. And so that's kind of how I manage with clients overall. Depends on the goals and objectives, depends on your risk tolerance. What can you stomach? Because I don't need clients, on the phone every other day saying, "Oh my gosh, I lost value," because investing is going to do what it does. It goes up and down. And so if you can't stomach that volatility, then I'm probably going to put it in something very conservative that's going to still get you a rate of return, but it's not going to have the volatility. And so therefore you may not earn a lot on it, but we'll protect your principal. So that's why it goes
Yeah.
back to the goals and objectives.
And that's why I said it's very subjective because it's really very specific to who you are, what your situation is, what your goals are. I get calls, email, um, social media posts almost weekly, Roz, saying to me, I have $100,000. Where can I put it? And my answer always is you got to talk to a financial professional who will help you look at your entire situation, what your goals are to get an answer. And I think because I talk so much about money and write about money, people think I can give you a quick answer and I just can't do it. I won't do it, and no one can do it. It is very particular, and anyone who tells you the answer to that question, if you ask somebody, where do I put $100,000? And they just give you the answer, run. Because if
Beware. Exactly.
run, because they
Mhm.
don't know enough about you to give you an honest and accurate answer. So thank you
Mhm.
for that. It's so important because if we're not thinking from a time perspective appropriately, then we'll
Mhm.
make an investment. I know someone right now who has a good amount of money, but it's invested in a way that it's completely illiquid, completely
Mhm.
illiquid. And anyway, so thanks for that. I could talk about investing all day. I could talk about every one of these subjects all year long, every week. But thank you for answering that. So the key to investing over the long term, especially, is diversification. What do we mean by diversification?
So great question, because a lot of times when I'm talking to clients, they say I'm diversifying because I got money at Wells Fargo, I got money at Bank of America, I've got money in their
Right.
mind that is diversifying. But I
Right.
have to bring them back to that's not really, it's in different places, but when we say diversify your portfolio, we're talking about what you haven't invested in. You don't want to have all of your money invested in cash because you're not going to get a good return on it. But by the same token, you don't want all of your money invested in stocks because stocks are very volatile, and that would be in a very aggressive portfolio. You want to have it kind of well rounded, and you want to have it in, some stocks, some bonds, some cash, some real estate. You want to make sure that you have a diversified portfolio, so that if one sector of the is not doing well, if you are a techie person and you want all your money in technology, well, we know how technology, sometimes you're lucky, sometimes you're not so lucky. Maybe you want to have something in a different sector, banking, healthcare, transportation, energy, right? All of those different things. So you want to make sure that you have it diversified so that you are taking advantage of when one sector may be down, another sector may be up. So that's kind of how we like stocks, bonds, cash, alternatives. If you have your base foundation set, because I'm not even having conversations. I get the young kids, coming to me. They want to put all their money right now in cryptocurrency. And I'm like, well, do you even have your emergency savings in place, right? Do you have that just basic money? So it just really depends on where you are, and we build to the more aggressive types of investments that you can look at with your assets that you have. But in any event, you don't want all your eggs in one basket. And what we mean by that is you don't want it all in stocks. You don't necessarily want it all in bonds. You want a very diversified portfolio that can give you a decent rate of return.
Yeah, and folks, later on this year, we'll talk more about the stock market in detail. But when you buy a stock, you're really investing in a real corporation. This is not like going to a slot machine or going to Atlantic City or Las Vegas and playing and gambling. It's risk, but it's not gambling. And it's only risk because the economy will do what the economy will do. But a stock is ownership, which means if you own a share of stock in a company, you get invited to that company's annual meeting. You can physically go and attend company's annual meeting, and you can vote. You're invited to vote on who the directors are for that corporation. So you're really a part of the economy. And your 401k, your 403b, your TSP investments are invested in stock. So you own stock if you have any kind of retirement plan. A bond is basically a loan to a corporation. It's a real corporation, and corporations go into debt through bonds, and corporations raise capital through stock. And so you want to know about the stock market and bonds, but it's not gambling. It's risk, but it's not gambling. And go on YouTube and other places to really learn. You really need to learn about the stock market to dispel rumors and to understand what Roz is talking about when she talks about diversifying assets. It is an asset. When you do your personal financial statement, whatever stock you own is an asset. It's just like the equity in your house, just like a savings account. It is an asset, and wealth is when you subtract your liabilities from your assets. If you have more assets than you have liabilities, if you own more than you owe, then that's wealth. If you owe more than you own, then you're broke. Doesn't matter what your income is. So wealth is not income, wealth is assets. And we're talking now about diversifying your assets to ensure that they're not all in one bucket. All right, we've got a few. Listen, folks, thanks for hanging in here with us. Type your questions in the comments because I'm sure there are people that have 401ks. You don't know where it's invested, and someone can help you understand that. And click the link if you need help, one-on-one help with a professional, whether it's debt, whether it's a need for coaching, whether it's a need for investing or insurance. Click the link, get help, and we will get you help. That's what we're here for. Next, after we talked about investments, here's the part I least like. I least like about um, finance, and that's taxes. I pay taxes every 3 months, Roz. As self-employed and as a business owner, I pay estimated taxes every quarter. Talk about the tax implications for the types of investments that we've been discussing.
Right. So the type of tax that you're referring to, of course, is your income tax, right? That is where all of us are going to pay income tax, and the goal is not necessarily to avoid paying taxes, but to pay your fair share of taxes. And I tell my clients often, I cannot help you to avoid paying taxes, but I can certainly help you to position your assets in a way that could potentially minimize the taxes that you are paying. So when you're looking at where your assets are, your pre-tax dollars, 401ks, 403bs, TSPs, any kind of pension plans, your individual retirement accounts, if you're self-employed and you have a set, those accounts you are funding, putting money in, and it is currently lessening your tax liability because it is reducing the amount of income that you are earning in that year that the taxes are paid on. And so when we start talking about, positioning your assets, I tell people max out your 401k. And when I'm saying max out, in the year of 2026, you can put up to $31,000 a year in your 401k or in your retired company sponsored plan. You can do that. After tax are things like your savings account, your certificates of deposits, if you have mutual funds, because at the end of every year, you're getting a 1099 that says this is how much you earned on these things in that year. And you have to count those earnings as income in that year, meaning that you've got to pay taxes on them for that year. And then we get into the third bucket, which is potentially tax-free, which is, tax exempt bonds or municipal bonds, where you generally don't pay taxes on. Life insurance. Here's another reason why people use life insurance to help lessen their tax liability, because generally you don't pay taxes on money that you take out of a life insurance policy. Your Roth IRAs, your 529 plans, if you have those for your children's education, those are all considered tax free, but you have to use the resources in those 529s for education only. Because if you use it for any other purpose, then yes, you will pay taxes and a penalty. So when we start talking about positioning your assets and putting your money in places to help you minimize your tax liability, it's we call it the 3 bucket strategy: tax now, tax later, tax never. You want some in all of those buckets to help you lessen your tax liability over the course of the year, because we're all taxed on an annual basis. Ever how much money you make from January 1 of this year to December of this year, there's going to be a tax associated with that. So you want to position your assets to lessen that liability.
Amen. I have nothing more to say about taxes. My
Here's the
least
thing,
favorite
Dr.
subject.
Soares. Look, you make a lot of money, because the income tax is based on the income you make. And so I have to tell some of my more affluent clients, hey, you making the money. We can lessen it, but you gonna have to pay some taxes. It's a blessing and a curse, right?
All right. Amen. Almost. Yeah, but there are certain states that are more tax friendly than others, and I
Oh,
think we'll talk about
absolutely.
that later on in the year too. All right, we're almost near the end, folks. Thanks for hanging in here. Don't forget, put your questions in the comments and hit the link for help. Um, I mentioned earlier that I recommend to my friends and family, I don't give financial advice, but my friends and family, I do recommend that they wait as long as they can to collect Social Security. We talked about it earlier. I think you've got some details about what that looks like.
Yeah, we call when you take Social Security, we want to, do it from a way that you can maximize it. So we do some calculations that says when is the best time for you to start taking it. And taking a distribution at 62, in this instance, assuming the payment is $1,400, if you live to age 95, you're going to get a total of about $969,000 over that period. If you take it, the distribution at 66, as you can see, assuming that payment is $2,000, then you're going to get a roughly amount of about $1,258,000, right? So we're calculating over the time how much money you will earn over that period. The goal is to break even, right? And so that's why we encourage people, you may not want to take it at 62, particularly if you're still working and you have income already. If you take it at 62, you're automatically going to get a 30% reduction. As you can see in this instance, you automatically get a lesser amount. And that amount doesn't change when you get to your full retirement age. You may get some cost of living increases over time, but you're still going to be getting less because you took it earlier. Now, the same thing will happen if you wait till later. You can, not take your Social Security up to age 70, and each year that you wait to take it, you get about a 30% increase. So again, if you're still working at 67, which is most of our full retirement age, and you can go to the ssa.gov, create an account, and take a look to see when your full retirement age is, and what those amounts will be for you when you start taking it. But you really want to be mindful of when you take it. And while you're not a financial advisor, the strong advisement for most people is, unless there are some circumstances that just
Yeah.
say you have no other income and this is what you need to do, then I advise don't take it at 62, because you do yourself a disservice when you do that. But the object is to maximize and really be strategic about when you take it. After 70, it won't matter because it's not going to increase anymore. So if you're 70, you should absolutely be taking it now, whether you have income or not. But understand that it's going to increase your income for the year, which then may also increase your tax liability to some extent for the year.
It's so painful. It's so painful. I didn't know. years ago that Social Security was taxed and that Medicare cost money. But that gave me a good reason to wait because you've got deductions from these checks, and then you got to pay taxes on these checks.
Mhm.
Uh,
Mhm.
and if you're married, these numbers go up because it's you and your spouse. So needless to say, I waited as long as I could, and I would have waited longer had I could. The problem we have as Black people, Roz, is that life expectancy often cuts us off from ever collecting Social Security. Black men die sooner than Black women. And
Mhm.
depending on your health, I mean, you said this earlier, depending on your health and your circumstances, you may need to go ahead and start collecting while you can, because you can't collect anything when you die.
Mhm. Right.
But this is a
Right.
great, I love this chart. This is a great chart, and I've never seen it before, but it really summarizes succinctly the reality of making choices about when to start collecting Social Security. It's a great chart.
Wonderful. Wonderful. Wonderful.
And
Wonderful.
I think the final topic actually is estate planning, because planning has run through all of what we've talked about for the last 2 weeks. Um, what is an estate plan? The word estate conjures up images of rich people, but your estate is not necessarily um, dependent on how much you have. It's just that you have anything. Everybody living leave something. And so we're talking about planning your estate such that there's no confusion after you're gone, right?
Absolutely. Absolutely. All of us, you said it earlier, you have your assets, you have your liabilities, and whatever you have after you subtract those liabilities from the assets is what you have left. If it's a 401k, if it's a home, if it's a car, if it's some jewelry, it is you have an estate. I have clients often that tell me, well, I don't have enough to worry about. And I say, you absolutely do. Been doing this work for now 35 years this year. And I have seen families totally destroyed
Oh, Lord.
because there was not a will in place.
Right.
Because Big Mama said I could have the couch, or whatever that thing may be. So creating a will, and in some cases, even having a trust if your assets are complex enough for you to have a trust in place. But that's the conversation for making sure who's going to make the decisions for you if you are incapacitated. COVID taught us a whole lot, but one of the things that COVID surely taught us was how unprepared we are to die. When people die unexpectedly and there's not a will in place, you don't even know, because we didn't organize ourselves, you don't even know where we're looking for the policy, we're having to ask the insurance company to hold tight, or keeping people out for 3 weeks, or doing a GoFundMe. Setting up a will and putting those things in place helps you to, even beyond the grave, dictate how you want your assets to be divided and who you want to have it. Parents, you know your children. You know whether or not they are responsible or not. Generally, there is one that is responsible. So, making that one responsible and then giving directives of how you want your assets to be divvied among all of the others, putting those things in place, naming an executor. Parents that have children, who do you want to keep your children? Had one case where the grandparents were at odds with each other because the parent passed away. Both grandparents want the child, and now the courts are left to figure that out. If you love your family, do not leave them in that state. A simple will and or trust, if your assets required, take the time to get that done. That is what estate planning is. It is planning what you own, even if all you have is a 401k, or even if all you have is a checking account. Make sure you've got a payable on death or a transfer on death on that account so that it transfers with ease, and folks are not having to fight over it or figure it out. That's all that estate planning is putting those things in place, making sure you've got proper beneficiaries on all of your life insurance policies, your 401ks, any kind of contracts that you have, your pension plans, even making sure that you've got those things set up properly so that your estate can transfer with ease.
Yeah, it's so important. I know a wonderful family that hasn't spoken. The kids have not spoken to each other for years because of a lack of a plan and the three different opinions about how the estate should be handled. It's so important and it's so easy to do. We have a resource on our website. Click the um, Get Help link, and we have a link to freewill.com. It's a free platform where you can write a will and sign it and print it out, and it's legal. I prefer that you go to an attorney, but at the very least, you can do a will right now. You never know what's going to happen. You could do a will right now and then take that will to an attorney who will sit down and ask you more questions and maybe flesh it out. The other thing, Roz, I'm so happy you said is this. Everybody does not need a trust. There's this entire industry that's that's trying to convince people that everybody needs a trust. Everybody doesn't need a trust. It depends on what your assets are. It depends on what state you're in. And so don't fall for the trap because there's some very slick looking, slick talking people on social media who want everyone to believe that they should pay them to help them establish a trust. A trust is important, but you need a professional, a financial professional, not a salesperson. You need a financial professional to help you understand the implications of your having a trust and what decisions you should make with regard to a trust. I don't have a trust. And I've been advised by both my legal and my financial professionals, I don't need a trust. Now, I may in 5 years establish a trust, but that's why you need a team with ongoing dialogue, ongoing analysis, and ongoing assessment of what your needs are, what your goals are, what your realities are. So thank you for mentioning that trust issue because it just gets on my nerves. A lot of people post on they comment on my posts that, oh, the solution is a trust. Well, it may or may not be, depending on who you are. All right. So that leads me to my final question, and that is, what should people expect from a financial professional?
So in this industry, we first of all we come a dime a dozen, but we don't all do the same things the same way. But
Yeah,
I strongly encourage everybody to work with a financial professional. You are going to need professional advice along your life journey, even if it's, when you're changing jobs, because now you've got to decide, do I leave it with the company, my 401k, or do I roll it over into my own IRA? But I strongly encourage you, you're going to need life insurance. You absolutely need life insurance. And so there are just some things that you're going to need professional advice on, and working with a financial team. As Dr. Soaries has mentioned, I believe everybody is going to need a financial professional. You are going to need a tax preparer. Doesn't necessarily have to be a CPA, but it has to be someone that can look at your taxes from year to year to help make sure that you are getting and taking advantage of the tax laws as they are changing annually. You may need a credit counselor to help you create a debt reduction strategy, and you're going to need an attorney. Dr. Soares, I'm a big proponent of using an attorney to do your will. There's lots of different platforms that are out there that you can, as you mentioned, log on, fill out the paperwork, but it varies. The rules vary from state
yeah,
to state. And so you want to make sure that you're dealing with, and it's your state of residency. Let me be clear
right,
about that. It is always your state of residency that is going to make your will legitimate or illegitimate. And
right.
so you want to make sure that you have these professionals on your team. And that is my shameless plug for working with a financial advisor, to make sure that you have the guidance, someone you trust, someone who you know has your best interest at heart, um, someone who I like to say to my clients, I become a part of their family, because I want to know it all. I know all the secrets. I'm going to go to my grave with a lot of people's secrets, right? Because it helps me. The more I know, the better I can help you to position your assets to be able to take care of your family the way you desire to take care of them. So
Right.
working with a professional is necessary.
No, it's not a shameless plug. I mean, the reason we're starting this whole series with you is because that's a priority. We cannot continue to depend on information gained from the barbershop, the beauty shop, and TikTok. We've got to talk to professionals. We need professionals to fly planes when we travel. We need professionals to take care of our bodies when we're sick. We need professionals to do our hair. I mean, you can't do someone's hair without a license. And so we need to start focusing on the use of professionals around our finances, and not every attorney. You notice she said tax attorney. Not every attorney understands money. There are many attorneys that don't understand a thing about money. In fact, many attorneys have to hire people to run their law firms because they're not good business people. So you have to talk to a financial professional, and the financial professional can even help you identify a good attorney for finances and for estate planning. So listen, Roz, you spend so much time with me, much more than I asked you to, and I really thank you for this. I plan to share this as broadly as possible because all of this is really foundational to getting our financial house in order. Folks, if you have questions before we leave, write them in the comments now so we can get back to you while we're still on the air, as it were. And make sure you get help. Get help. We have all kinds of help. If you're thinking about buying a car, we have help on how to buy a car, what leasing is versus what buying a car is, interest rates, and join the DFREE community, dfreecommunity.com. It's free. We interact with each other. We have a money date every Wednesday at 2 where we invite people to just meditate, reflect, listen to smooth jazz music, and do something about money. Pay attention. The DFREE movement is growing. We're in churches, we're in schools, we're in community organizations. Our largest partnership is with Delta Sigma Theta Sorority Incorporated. We're working with the National Baptist Convention. We just started working with the Churches of God in Christ denomination. We're working with Zeta Phi Beta Sorority Incorporated, and the list goes on. We're here to help you change your mind about money and then to take action on what you've done. I want to thank our production team for all the work that they do and invite you to come back next week. We'll have another segment of the Wealth Lab, and every month we'll have an advisor from Prudential. As the advisor, will be a part of the Wealth Lab. And once you discover, then you can execute on what you've discovered. Thanks for joining us, and we'll see you again next time.